All right, let's talk about investing. If you've ever thought about it, but then got totally overwhelmed by all the noise, stocks, crypto, and all the warnings from friends and family, then you're in the right place. We're going to cut through all of that confusion and break it down step by step. So let's just dive right in.
Sound familiar? This is probably the first thing you hear when you mention you're thinking about investing. And hey, it's a valid fear. The thought of losing your hard-earned money is, pretty terrifying.
But here's the thing. While everyone is so focused on the risk of losing money in the market, there's this quieter, kind of hidden danger that gets almost everyone, whether they invest or not. So let's talk about that hidden risk. It's not some scary stock market chart. It's something that affects all of us every single day. It's called inflation.
So what does that actually mean? Well, simply put, that money you've got saved up in a bank account, it's slowly losing its power. $1,000 today will buy you less stuff next year, and even less the year after that. It's kind of like a slow, invisible leak in your financial bucket.
And that's where this comes in. To actually beat inflation, your money can't just sit there. It has to be put to work. It needs a chance to grow faster than its value is shrinking. And that, right there, is the whole reason we invest. Okay, so you get it. You need to invest. But where on earth do you even begin? Well, let's open up the toolkit and look at the basic building blocks you have to work with. These are pretty much the four main ways you can invest. You've got stocks, which are basically tiny pieces of companies. You've got commodities, think physical stuff like gold. Then there's cryptocurrency, like Bitcoin. And of course, real estate. Each one of these has its own personality, with its own set of risks and potential rewards.
For most beginners, stocks are the easiest place to start. But let's be real. The idea of trying to pick the next big thing is a lot. So here's a great piece of advice from one of the best investors ever. You don't have to. You can just bet on the entire market. But how do you do that?
The secret is something called an ETF, or an exchange-traded fund. Now, I know that sounds like a bunch of financial jargon, but the idea behind it is incredibly simple. Think of it less like buying one single thing and more like buying a pre-made collection of things. It really is that simple. Imagine a shopping basket filled with hundreds of different stocks. Instead of trying to guess which single stock will do the best, you just buy one share of the entire basket. That way, if one company does poorly, it doesn't sink your whole investment. And the most famous of these baskets is the S&P 500. By buying just one share of an S&P 500 ETF, you instantly own a tiny piece of giants like Apple, Amazon, and Microsoft, the whole shebang. On average, it's returned about 10% a year. It's basically investing on easy mode. Now, of course, not all investments are the same. Some are like a slow and steady climb up a mountain. Others are more like a roller coaster. It's all about figuring out the trade-off between risk and reward. And wow, this chart really puts that into perspective, doesn't it? I mean, just look at that. $1,000 in Bitcoin 10 years ago could be worth 150 grand today. The S&P 500 in gold did just fine, but they're not even in the same universe. But before you go and put all your money into crypto, you have got to understand the other side of that coin. That incredible growth comes with some seriously heart-stopping drops. It's what we call volatile. It can shoot up one month and then crash the next. Remember, high reward almost always comes with high risk. So what about the other two? Well, commodities like gold are often seen as a safe haven. When the stock market gets rocky, investors tend to run to gold for stability. And then you have real estate. It's popular because, it's a physical thing you can actually see and touch. The only catch is it usually takes a lot more money to get started. So you have these high-growth, high-risk assets and these slower, more stable ones. How do you combine all of that? Well, that brings us to what is maybe the single most important rule in all of investing. And it's this: don't put all your eggs in one basket. It's really that simple. The goal isn't to be a genius who picks the one perfect investment. The goal is to build a portfolio that can handle whatever the market throws at it. And here's what that can look like. This portfolio isn't betting everything on one thing. It's got a mix of everything we've talked about. So if crypto has a terrible year, maybe the stocks do really well and balance it out. That balance is the real key to stable, long-term growth. But what about that fear we started with? The big one. What if the whole market just crashes? Let's tackle that one head on. If you look at the history of the stock market, it tells a really powerful story. Yeah, you can see those terrifying moments like the 2008 financial crisis or the big dip in 2020. They feel awful when they're happening. But if you just zoom out and look at the big picture, the trend is pretty clear. The market has always, eventually, recovered and climbed to new highs. And this is the key takeaway, maybe the most important one of all. Your portfolio might show a loss on paper, but that loss only becomes real if you panic and sell at the very bottom. If you have patience, history shows us that the market finds its way back. And look, you really don't need to be a millionaire to get in the game. With modern apps, you can get started with as little as $100, sometimes even less. How much you start with isn't the important part. That you start is. Because really, the most expensive choice you can make is just waiting. Every day you wait is another day your money isn't working for you, and another day that inflation is quietly eating away at what you've saved. So the only question left is, are you ready to get started?